I thought what we'd do to kick this off is ask Kevin first and then Alex to spend a few minutes just kind of introducing yourself to the audience by way of talking a little bit about what you're working on these days, what you're seeing in the business, and at a higher level, how you think international cross-border transactions differ from what a lot of people might be accustomed to working on more domestic-oriented deals.
All right, so Kevin Jacques. I currently head up the corporate venture group for Visa. I've been at Visa about 6 months. Prior to Visa, I was 6 years running M&A and investments at Intuit, about 18 years overall in venture, corporate venture, and M&A. Visa, we're everywhere you want to be. So hopefully in all of your wallets. If not, see me after the panel and I'll connect you to some of our wonderful partner banks. But that does mean globally. We are in almost every country around the world. And at Visa Ventures, I was recruited with a charter to help us be more aggressive in becoming an open network, an open and a better partner to lots of the emerging fintechs around the world that are better meeting the payment and credit needs of consumers, small business, and big business. And was tallying up some numbers as I was sitting through the last panel. In 6 months, we have had at least initial approval, 4 investments closed, another 7 where we're through one gate of approval and we're in diligence and hopefully on a path to final approval and close. Majority of those are global. 8 of the companies are pretty much non-US in their focus and in their incorporation. All of the companies have some major aspect of their business, either a set of customers they address or some key piece of their operation that exists outside the US. So global issues and investment are paramount to what we do. And looking forward, I think the shift towards more global versus domestic will probably accelerate. Our opportunity to grow our business is more cards and more Visa around the world. America, Europe are both fairly, I wouldn't say saturated, but well-penetrated markets in terms of consumer use of card. Globally, fantastic headroom in front of us.
Thank you.
So at Softbank, we're a Japanese company. We're listed in Tokyo. Our headquarters are in Tokyo. But the bulk of our business is around the world. We own a $100 billion plus stake in Alibaba, the leading Chinese e-commerce company. We are the largest shareholder of Sprint. We have made investments through our Vision Fund into large leading tech companies such as Uber in the US, Flipkart in India. And then we do also have a big business in Japan where we're the largest shareholder of the Yahoo Japan business, which is a very successful $25 billion market cap business. We also are one of the 2 or 3 big wireless companies in Japan. So virtually everything we look at is cross-border. We have big ambitions across the tech sector and across the world in places where we think that, in particular, large amounts of capital can be dispositive in moving the needle around growth. And so we chase big companies that are not afraid, and we're not afraid to pay big prices for those big companies. So in late 2016, with Mofo's good advice, we purchased 100% of a company called ARM, which is a semiconductor IP and design company based in the UK. They were worth about $23 billion in the market. We really wanted the company. We stretched. We paid $32 billion for it. For us, again, everything we do is cross-border in terms of new stuff. The Japanese market doesn't necessarily have the kinds of growth characteristics for big businesses where we'd want to play, though we are active in finding smaller, growthier businesses, entrepreneurs in the Japanese market. In terms of differences, we're generally conscious that the 2 or 3 or 4 sides of any table where we're negotiating has people who have different regulatory environments. Often, their stock is listed in different places, which means they have different rules they have to abide by. Certainly, they'll have different governance standards internally, different cultures about how they like to get deals done, how they like to work with assets that they own or that they're buying or that they're selling. And so internally, we have a very international group of people that attacks these opportunities. So, our chairman is a Korean national who's lived his whole life in Japan, but came to the US for college, went to Berkeley, I think it's that way, before going back to Japan to start his business. Though he'll remind you he did come up with some inventions that he sold while he was a college student before even going back to Japan. But the bulk of what he's built has been first in Japan and then around the world. Of the, and then of our board directors, which is somewhat uncommon for a Japanese company, where they're, it's generally a very Japanese system. Our board directors, our vice chairman is a South African-born, now American citizen based in Boston, an Indian gentleman who is the CEO of our Vision Fund, who's based in London, Marcelo Claret, who's the CEO of Sprint today, who's Bolivian, grew up in Bolivia, started his business in Latin America, expanded it around the world, is based now in Kansas. We have representatives from PIF, which is the Saudi sovereign wealth fund. And so everything we look at is from the perspective of multinational individuals and assets.
Thank you.
If you're interested in additional information on innovation and M&A, I encourage you to check out the Transaction Advisors Institute, which is a robust source for knowledge on M&A best practice.
We host a series of M&A conferences, run an elite M&A Academy, offer M&A Master Classes, conduct M&A research, organize the M&A Leadership Council, and publish a prestigious M&A journal.
Members of the Transaction Advisors Institute include corporate executives, board members, and private equity investors that are interested in understanding the critical issues impacting transaction planning, structuring, and execution.
I encourage you to get more involved in the Institute.
The topic of cross-border transactions can be dissected in lots of different ways, and I'm sure you've heard presentations on this in the past. What we're going to try and do is talk through a variety of issues that we see come up regularly on cross-border deals. We're going to start at a higher level of abstraction in terms of, as you're getting going, what do you think about is the precursor to really launching the deal? What are the important items that you focus on initially in doing deals? Then we'll get into a little more detail on some of the deal structuring devices that these gentlemen have used to accomplish different goals along the way, and then we'll finish on regulatory. Because there is a lot of activity today around regulatory, particularly as it impacts inbound investment in the United States, but there are some lessons learned and some practice points that I want to be sure you take away with you today on the regulatory side as things are evolving there. So maybe I could start, Kevin, and you're about to launch an international transaction, an investment or an acquisition. What do you think about first to get organized and to make sure that you're proceeding on a sound basis?
Well, first and foremost, have good legal counsel, a good partner like Morrison and Foerster.
There's a disclaimer here, which is we're fortunate to work with both of these companies, so I stacked the deck, and you should know that.
Just a partner that I think a larger firm that does have resources in market can be a real contributor to a higher success rate and a better batting average. There's lots of nuances, at least in my experience, depending on the specific country that you're investing in, to getting it right. And being able to work with one firm, one set of partners, and have some of those complex issues sorted through, by someone you can trust is helpful. And where it really helps, Visa, I'd say, in the role that I'm in now, we're typically making much smaller investments, let's say, than Softbank. But we're trying to become aligned with partners that are going to be distribution partners. We're making an investment in conjunction with a commercial agreement. We need those partners and the leaders of those companies to be committed to working together, to working through issues that are inevitably going to arise, in our relationship and to promote the Visa brand and drive a great outcome for both of us. To do that, we really need to win their hearts and minds. And beyond all these complex legal issues, also a firm that can help give us coaching on what are the cultural norms about negotiation in a particular market can be very helpful.
Look, all of that rings true for how we chase transactions. Certainly having the right advisors at the outset who can help us understand what the rules of the road are, that's paramount, right? There's certain places where you go right to the CEO and you start a conversation and that's fine. There are other places you want to be careful. There are places where, in the UK, for example, there's a board and there's a chairman. The chairman is usually a non-executive. And it's kind of protocol that you go to the chairman first to kind of, it's like you're asking for his child's hand in marriage as opposed to, going directly to the CEO who's running the business. The other thing I'll say, and this is true on the way in, even though often the outcome is only seen on our way out. The whole, this Bill Clinton advisor, James Carville, who put up this sign and said it's the economy stupid. Well, for us, it's taxes stupid, right? Are you structuring the transaction in the right way from a tax perspective? And you need to be doing that really early because it can take time to put these structures together. You need to get everyone around the table to buy in to some of these structures. But they have enormous impact on the value that you create for yourself that obviously you'll see at exit. And then when you're looking at selling, same thing, buyers will understand what entities they're buying from you because that will impact, one, their own tax perspectives, but then two, financing and other matters. And so tax is always super important for us, even more so when you look at cross-border deals, because do you want to buy a French asset with an holding company in France, in the UK, in Japan? There'll be different outcomes for all of those depending on what kind of a deal it is, when you think you'll exit, what kind of other assets you might have to offset gains in those jurisdictions. And so we're very, very focused on tax as well.
Let me just take a moment of departure on some of the pitfalls to be aware of when you're approaching a cross-border deal that may not be intuitively obvious to people here because they are different than the rules we're used to. Let me just give you some illustrative examples, which is, over the last 5 years, it's been the case that the privacy rules and the protection of personal information in Europe, for example, have been much stronger than they have been here in the United States. So sending your standard due diligence request list to a European entity and asking them to give you information about their employees can end up creating a situation where if they actually responded to that and were not well advised by counsel, you could find yourself and they could find themselves in violation of European privacy laws. So point number one. Point number two, in our experience, maybe Alex wants to comment on this as well, we saw in the Arm acquisition, Arm was a public company in the UK, and throughout Europe, UK included, there are much tighter rules around the process for engaging with a public company in an acquisition. And that includes the put up or shut up rules, and we'll let Alex talk about that in a minute, but also just the triggers on public disclosure where a company that here in the United States you'd be negotiating with, and if there are rumors or perhaps movement in the stock price, you'd both assume the standard response would be no comment. In Europe, there are much tougher rules about whether there's an affirmative obligation on the part of the target company to come forward and state that there are negotiations going on, which in and of itself can prevent a deal from happening to the extent it affects the market price and causes it to move to a range that you can't execute a deal on. So these are all things you need to be aware of. Maybe you want to talk for a minute about the put up or shut up rules and how that affected you.
It means you need to have, well, at least in the UK, you better have conviction from the outset, both because you might get outed, and if you're outed, you have a certain period of time to either make your offer or not make your offer. If you don't make your offer after you've been outed, if there's a leak and you've put out a statement that says, yes, we are talking to this company, if you don't put up an offer within a certain period of time, you need to then go away for, I think it's a 6-month period. Yeah. The other thing in the UK is the diligence standards are very different here, right? If you go and talk to a US public company, you get the CEO to buy in, you talk to the board, you generally can go really, really deep in diligence. In the UK, there's a perspective that, look, public disclosure is supposed to provide you with all the information that you need to make a reasonable acquisition offer. And so you can go in, you can ask some questions. There were certain things we cared about that were not publicly disclosed, where we got a little bit more information, but nowhere near the kind of information if we'd bought a US company, which would have had a pretty similar standard of public disclosure. And so all of these things, you better be ready to do a deal in these markets, and people internally better be comfortable that, look, when we go after this UK company, this is going to be the standard.
Another area that you will see a rise in international transactions that don't appear to be a issue here domestically is the whole question of anti-bribery rules and corruption, which is a place that I ran into issues on a transaction I handled for Visa years ago when they bought a company in South Africa. And that company was engaged in providing payment services over wireless telephones throughout Africa and Asia. So one of the first things we did on that transaction is we grabbed the heat map for global corruption. And if you're familiar with the organization, several will publish a map that shows in various shades of red how corrupt the particular country is perceived as being. And then we overlaid that map against the places where the South African company was doing business, and there was almost a direct correlation between the two. So that led to a variety of issues that we had to deal with in that acquisition that you don't normally see here. And the way our corruption rules work is that they not only apply to the company itself, but they apply to distributors for the company, and you can buy into issues as a buyer if they pre-existed your ownership of the company. So you need to be very careful up front in doing your diligence. And fortunately, in this case, it was a private company. So we were able to structure a deal where a lot of the more intrusive diligence that they would have objected to initially, we were able to do between signing and closing. And we're fortunate enough to get a closing condition that required that we would be satisfied with the outcome of that due diligence as a condition to closing. So I just put that out there as something to be aware of.
I'll throw out one other area, and that's HR policies and practices of the companies you're acquiring. And for us, making much smaller investments, particularly smaller relative to Visa's overall balance sheet, say, than Softbank, and a very similar dynamic in the acquisitions we did at Intuit. We were typically buying sub-$100 million companies for capabilities. We were buying very small companies. And optimizing tax is important, but brand risk is an even bigger threat. For Visa, brand risk is really probably the biggest issue we look at as we look at acquisition and investments around the world. Almost every emerging company that I've dealt with has been willing to take a much more aggressive posture in their HR practices than a big established company would take. Where the big company would say someone's an employee, the little company will take a risk and say they're a contractor. Well, when you buy that company or you invest, you're putting your brand at risk behind that. HR law is complex enough in the US alone, but when you start to look at, well, what do I need to watch out for globally? Again, it's a great situation where a very experienced set of legal partners can help you understand where the landmines are and the potential risks in that market and help you focus your diligence.
Thanks. Let's shift gears a little bit now and go to more specific deal structuring questions and how you approach transactions. And let me start with the venture style investment that you do and that at a larger scale that Softbank does. Historically it was the case, I think, that while there's a very well-developed venture model here in the United States in terms of the types of securities that are issued and the terms you would expect to get in a venture investment, I've always found doing international investments that there is much less of a standard to work from, and oftentimes a more limited range of securities you can use to accomplish your business goals. So maybe you could start, Kevin, just spend a minute talking about what you perceive today. Are venture standards becoming more international? Are they becoming more consistent in various countries? And how are you finding the use of preferred stock, or what other tools are you using in your investments?
At early stage, and we tend to be looking at companies that are kind of A, B, C, D stage, there is actually a reasonable degree of standardization, at least in the deal flow we see around the world. So we're almost always investing in preferred stock. The proliferation of incubators that have taken the SAFE model and kind of localized it but rolled it out globally does create structures that don't look crazily different from what we might see in the United States. Valuations vary depending on the market. In some cases, I might observe that there's as much difference between East and West Coast terms here in the United States as there might be between West Coast and, let's say, Latin American countries. We do our best to be very consistent in what we ask for. So it's preferred stock. Often they're companies that are not yet profitable, so we want to stay below a threshold and not have any perceived control, so that we're not consolidating the financial results. We're looking for terms like a right of notification. Almost always we're making the investment in conjunction with a commercial agreement and a clear set of changes or advantages we've created in an existing commercial agreement in conjunction with the investment. So some form of recognition that we are the preferred or perhaps exclusive payment network partner for the company we're investing in.
Let's talk for a minute about the point you made on the accounting side. Years ago when I worked in Japan was just becoming more of a site of inbound transactions, and a lot of major U.S. companies were entering that market for the first time. Often one of the techniques that we used would be to structure a deal so that initially when the joint venture, which was typically the case, was starting up, that the U.S. company did not have control and so did not have to consolidate, as you just described, but would put in place tools in order to increase its ownership percentage and actually get to control and consolidation later if the joint venture proves successful. Is that something you look at doing, or is that something, Alex, that you look at doing as you're doing investments?
I would say 90% of the time we're investing with a clear sense that this is a partner and a partner long term. So we're hoping that they achieve independent liquidity. I would say interesting that you mentioned Japan. We do see different corporate co-investor behavior around the world. We're working on a deal now where the lead investor in the round is a corporate that is very interested in showing the market growth. They're willing to have a much higher percentage ownership position, consolidate the results of the company, and absorb losses for several years because it achieves their strategic objective of showing a growth story.
We'll often do unconventional deals around one, size, obviously, but two, structures that we want. We'll often buy common and preferred if we're trying to build a big position. We'll often buy some secondary, we hope at a discount in addition to primary, again, in order to build a bigger position. We'll often want to put money in, but also have specific relationships with other parts of the Softbank family, whether that's a joint venture to drive an Asia business or a partnership with one of our portfolio companies in Japan, for example. So that adds additional complexity. We're usually not so focused on, we kind of, our views on each of these companies is generally pretty specific to that company, and so we tend to often look at different types of deals depending on what we need to do to achieve what our objectives are with those deals.
And talk to us for a minute about kind of your planning around liquidity and an exit event going down in time. Kevin, you mentioned earlier you're looking at these as long-term partnerships, but do you also approach your structuring up front with an eye to how will you exit or profit from this investment if it's successful?
We absolutely do. I don't think we would make an investment if we didn't see a path to liquidity. That said, we often have concerns about, who might be the potential acquirer of the company, and so we're in most cases seeking rights of notification, rights of first negotiation, if an acquisition offer were to come from a defined set of people that we would consider competitors.
Mm-hmm.
And our fund is, we intend to be more strategic than just being a financial investor. But the fund is structured with a life, and at the end of that life, we need to have sold our investments. So absolutely, I think we'll probably take a longer view on liquidity, but sometimes buyers show up earlier than you thought, and then you need to take that into account. But yes, we're also we probably focus much more on, is this business going to be worth a lot of money? Will it be wildly successful in 5 to 7 years? More than, okay, exactly how is the exit going to work? Sometimes it's kind of obvious, if you're investing and there's a big partner and that person is committed to an IPO, then, okay, you need to think about, is that an IPO market that is generally an attractive IPO market? How, what are the liquidity requirements around being able to get out? For example, as an early sponsor of a Chinese company, if you go public in China, you need to stay in the stock for 2 or 3 years after IPO. Okay, so that's a little less attractive than other markets where you could sell potentially all of your shares at IPO. So we do some planning around what exactly is the exit going to look like, but we care much more about, is this really going to be an enormous success for us financially, and then we're a little bit agnostic on how the exit comes, recognizing that sometimes a buyer shows up that surprises you and you want to be flexible for that.
Talk to me a little bit about governance rights as you come into these investments. What's your focus on governance, and how do you best go about executing on that?
Well, we're interested in not creating liability for ourselves first and foremost, so we take board observer but not board seats, and we're pretty consistent in that practice. That said, we will look to, in certain situations where we think it's appropriate, put limitations in place or mechanisms that do give us a voice, and a strong voice, in the governance of the company. So a recent example had come to mind. We had a company that's very close but not quite yet profitable. We have a board of existing investors that we fear might be out of dry powder to carry the company forward. Us not being on the board is a risk. We worry that they might be very happy to spend all of our money and more to do things that they would see as useful in the company. But what we did was, for example, very precisely define a set of about 8 or 9 different conditions where we thought it would be important that the series of stock that we controlled would have approval rights over those decisions. And we're able to defend that to the company, explain that we thought it was in our mutual interest that together we got this company to cash flow positive, and ask me in a year, we'll see if it's worked.
Alex?
On governance, we tend to be we tend to be very strong backers of the usually founding management team, and so we get, we are happy to get the right protections, but we're not too prescriptive around, we absolutely need this or that, because generally it's more about figuring out, does our vision coincide with the management team's vision to build a very big business.
Let me switch gears a little bit, talk about acquisitions as contrasted to investments. We've been focused on minority investments. Just a few words on acquisitions. First, if you're looking internationally, particularly to Europe, and you're doing a acquisition of a division from a large company, or perhaps a large company that's not public and has limited shareholders, generally the same process, but I would note that you will typically see in European-style transactions that they're structured in a much more seller-favorable manner, by which I mean that you will find that once the deal is signed, that most of the risk transfers to the buyer. There are more limited operating covenants, there are more limited closing conditions, and it's much more difficult for a buyer to get out of a deal once it's signed. There's also a much greater reliance on rep and warranty insurance, which is something that today is entering the market, has been more prevalent in Europe for some period of time. And so all those attributes of transactions make Europe a great place to be a seller, but a less desirable place to be a buyer. What that means, in my experience, is that if I'm advising a client like a Softbank or a Visa making an acquisition of that kind in Europe, I would typically advise that you go in, unless it's a competitive auction where it's truly going to disadvantage you, with a very U.S. point of view. You have U.S. lawyers represent you, you have a U.S. style document, and you explain we're going to do this in a U.S. manner. On the other hand, if you're here in the United States and you have a European buyer coming in, then it's, well, if we're going to sell our company to you, we're going to do it European style because we think that is something you'd be familiar with. And of course, that's a more comfortable arrangement ultimately for a seller. The other thing I would mention is that if you're buying a public company or a company that has a large dispersed shareholder base, here in the United States, we're very accustomed to using a merger structure in order to be able to effectuate a transaction like that. And one of the benefits of using a merger, and one of the reasons that that statutory framework was created here in the United States in the first place, is it makes it easy for you to squeeze out minority shareholders who might not otherwise vote in favor or support a transaction. As long as you get a majority vote in favor, depending on peculiarities of a company's charter, you're able to take out all the other shareholders. Merger statutes are pretty rare outside the United States of America, unfortunately, which means you fall back predominantly on tender offer structures. Europe or in England, they have a scheme of arrangement, but that requires obtaining levels of approval much higher than a majority standard, and sometimes review by bodies like listing organizations that review not just from a disclosure standpoint, but also from a standpoint of fairness and appropriateness of the transaction. I worked, for example, representing McKesson, a very large San Francisco-based healthcare services company, in an acquisition in Germany of a company called Salacio. And one of the things that happened there, which was forecasted in advance and inherent in the limitations of the approach you can take, is that they were not able in the tender offer to secure 100% of the selling shareholders' approval, of course. And so that left a public stub out there that takes a fairly long process under German rules in order to clean up eventually. And today, U.S. activist shareholders like Elliott, that you've probably heard of here in the United States, are at least as active in places like Europe because there are these inefficiencies, at least we believe from a U.S. model standpoint, in how deals are structured by virtue of the statutes that are just easy for them to step into a deal like that and try and negotiate a higher price in the second stage squeeze out of that transaction. So just something to be mindful of as you're planning large-scale mergers in places like Europe or Japan, for example, because it's not going to be as straightforward or as easy, and you need good advice up front as to how you're going to ultimately be able to execute on that to secure your goals. So I don't know if you have anything to add on that.
I mean, that's all true. So yes, we care about those things. And the one thing that's interesting is as we talked about on the earlier panel, there's always the concern about employee retention going forward. One kind of interesting twist about Europe, or basically most markets other than the US, is that you'll have much less ownership among the management teams and the employee bases of these assets that you look at. And so you can sometimes feel a little more comfortable that people will stick around because you haven't given them the kinds of pocket change that senior management teams in the US will often get, not just because of their packages, but because of the special merger-related agreements that they get between signing and closing. So that's one thing can be slightly helpful in Europe, but yes, in the rest of the world, the idea here, relatively speaking, it's easier, everything else being equal, it's easier to buy 100% of a company here than in many other markets around the world.
So I'm going to segue now to regulatory, because we can't, of course, spend time talking about anything international these days without talking about Washington, D.C. along the way. But before I get into a conversation about CFIUS, I just wanted to ask you two whether there's anything you want to say about either U.S. or international regulatory environments as they impact your activities.
I'll go first, Ian. We tend to be regulated by central banks and payment regulators, which fortunately, on one positive hand, they tend to be less impacted by short-term trends and winds of politics, which is a positive. On the other hand, there are central banks and regulators around the world that we feel are doing their best to favor some local payments players and incumbents, and that has remained consistent, throughout the last several election cycles. So we wouldn't say there's been a real change in, what we're facing as a business from a regulatory perspective. On the other hand, we do think there is a heightened brand risk, presented to us or other American brands at this time, that consumers around the world may look at the U.S. in a slightly less favorable light. So we need to be very careful as we're a global company, but oftentimes we're perceived as a U.S. company.
We do our best to have our regulators like us, and we try to engage with them as early as we can. The UK had some controversy around acquisitions by foreign companies of assets that were seen as iconic core UK assets, where the foreigners had said prior to the acquisition, don't worry, we're not going to fire anyone. Post-acquisition, they shut down factories and cause a lot of pain to those factory towns, and we were conscious of that concern, and so we committed to some very strong requirements around hiring in the UK going forward, and around where the headquarters would be, and those are legally binding commitments where the UK government can come and sue us and fine us if we don't abide by them. And did we absolutely have to do that in order to get the deal done? This was the UK, right? It was not Indonesia or another difficult regulatory market where they make you do all sorts of things. We could have said, look, we'll do our best. But actually, we wanted to go in and have a relationship that would be very positive going forward. And so we went very farther than other buyers had gone in the past. We knew that was an additional cost to us, but we were willing to make that investment in order to be seen as someone who is very UK friendly. And we think that starting that way has been very helpful to us, both for the work we're doing at ARM, but then also for additional activities we may want to pursue in the UK.
Let me use that as a segue now to talk a little bit about CFIUS, the Committee on Foreign Investment in the United States. It is a very active topic today, particularly on inbound investment in the United States. And there are now more filings, more CFIUS reviews, and more mitigation being sought by the U.S. government in CFIUS than has ever been the case in history. And of course, this year started with the Broadcom Qualcomm transaction. For those of you who did not follow it, of course, it is a transaction in which Qualcomm, a US-based company, was subject to a proposal including an unsolicited tender offer by Broadcom, headquartered in Singapore, to acquire the company. And there was a great deal of resistance on Qualcomm's part to the transaction. Broadcom had filed a CFIUS filing, or was preparing to file a CFIUS filing, when the US government intervened in the transaction at the direction of the president and said, we're not going to allow this transaction to go forward. That was unprecedented in terms of the stage of the transaction at which the government intervened. No documents had been signed. There was just discussion and considerable press around the transaction. And they intervened and said they were doing so because of a couple features. One was the continued importance of research and development in the United States, and the notion that Broadcom, a leveraged company, would be even more leveraged to execute on this transaction, and that might imperil their ability to continue to invest in R&D to the same extent. And the second was the importance of 5G networks in the United States going forward, and the risk that Broadcom had perceived relationships in China that would then be brought to the United States and could jeopardize the quality of the network and the speed at which it would be rolled out here in the United States. So for those stated reasons, the government intervened. It's illustrative of a few trends in the CFIUS area today. The first is the increased scope with which the government is applying the CFIUS rules, driven by a couple things. One is the importance of privacy, personal information, and security. They intervened earlier, a few years back, in a hotel transaction because of the view that the hoteliers had a great deal of private information about guests who were staying in the hotel, and that was sufficient to get their interest. So industries that historically may have thought that they were outside the scope of CFIUS because they really weren't engaged in activities that related to national security of the United States, today find themselves embroiled in CFIUS reviews, be it hotels, insurance companies, financial services institutions, and of course others like automated automobiles, self-driving automobiles, and tech companies generally. It's one trend. Number two, a second trend is just the antipathy that the U.S. government is bringing to any investment involving China today. And as a corollary to that is the third, which is their focus in expanding the reach of the U.S. government's CFIUS review, even to foreign transactions between two foreign companies that don't have a U.S. participant, but nonetheless one or both the parties have sufficient U.S. assets and activities that the U.S. government will extend its authority to that transaction, and then may choose to intervene because, for example, one of the parties, again, not a U.S. company, has a joint venture in China with an entity that they consider to be one that they would prefer not to see have any access to the United States. We advised a company out of Europe, out of a very friendly nation with the United States, that was making an acquisition in the semiconductor area, so it was somewhat sensitive technology, that was buying the assets from a U.S. company, and the U.S. government in the CFIUS filing intervened and said, we don't want to see this go forward, in part because the U.S. target company, the European buyer had a joint venture with a Chinese company, and they were concerned, the U.S. government was concerned that that joint venture in China would be a gateway for the Chinese company to have access to the technology that the U.S. target possessed. And so on that basis, they intervened. So the scope of intervention is today quite broad. There's also legislation pending now in Congress that has bipartisan support that would extend the CFIUS review regime further by extending to joint ventures that U.S. companies enter into outside the United States, and even to technology licensing deals where U.S. technology is licensed outside the United States. There are a number of countries like Israel that have rules like that. The U.S. has not historically had a restriction of that kind. It is getting a great deal of resistance from the U.S. tech sector in particular. We'll see what the final legislation looks like. It is likely something will be passed in this area. So stay tuned, because your activities that historically you've thought would be outside the scope of a review like CFIUS may in the future be more subject to government intervention than you're currently accustomed to. And then finally, just a minute on kind of the impact that that has on your outbound investing activities and retaliatory measures that are being taken by foreign governments, or at least efforts on their part to have similar regimes in order to protect their domestic national security. I would just note that in China, of course, when you file, you have a MOFCOM review process that is ostensibly a antitrust competition law review, but in fact often looks a lot more like industrial policy and is becoming increasingly difficult as the U.S. on our side extends its regimes and its rules to China. For example, the ZTE situation recently, where the U.S. government said U.S. companies can't supply technology to ZTE, was based upon a very obscure Department of Commerce regulation that had been out there forever. And it's premised on the fact that ZTE apparently was one of the worst violators of the Iran sanctions and North Korean sanctions. So there was good reason to actually make a point about ZTE, but they pulled out laws that no one was even aware existed or certainly had not been applied for some time. That kind of activity is likely to lead to some retaliatory measures potentially. And then, as you heard earlier from Alex, today in the UK, in Germany, and in Australia, and potentially other regimes as well, as those countries watch the United States expand the jurisdiction of its CFIUS rules protecting national security, they too are acting the same way, that in all of those countries and potentially more, they are now adopting new rules or more aggressively enforcing ones they had in the past that are intended to protect their national security and give them the ability to intervene in inbound investments in their countries. Australia the most aggressive, then the UK, and then Germany after that. So let me see if you have any further comments, and if not, maybe we'll turn it over to the audience for questions. Good. We're right on schedule, but I assume we have a few minutes for questions if people are interested.
We do have a few minutes for questions, and since I have the mic, I'm going to go first. Are you seeing anything in deal structures overseas that may be portable here? Things that are clever or innovative, and a few ideas come to mind to perhaps illustrate the question. We track in the UK the increasing use of the lockbox closing mechanism for managing working capital. We see again in Europe the prevalence of reverse, or what they would call vendor due diligence, in different deal terms that rely upon the diligence that the seller has provided. Just two examples, but are you seeing anything clever that we could adopt or use or consider with regard to structuring deals here?
I'll jump in. Very Visa specific for us. If I think about the most successful investments financially Visa's made over the last 6 years, one or two that have returned in the neighborhood of 100 million each. The commercial value, the strategic business value, actually is an order of magnitude more than that. So it's very important that we get that commercial deal right. And our global teams have been very thoughtful in a couple recent deals about delaying or staging some of our financial investment and tying it to the partner actually completing some of the certification or moving through a process and then issuing Visa cards. Not a revolutionary structure by any means, but one that we are trying to implement globally just to further make sure that our strategic and financial interests are very aligned with the companies we're investing in.
So the mechanisms you described, I think, are consistent with the overall paradigm that Europe is a more seller-favorable market. So I would say PE funds are okay with seller-provided diligence and are okay with rep and warranty insurance and find that an efficient way to execute deals. And in fact, if they're comfortable and experienced with it, may give them a leg up in competing with their strategic. In my experience, most major strategics are not very interested in diligence provided by the target company, even if it's contracted with an outside party, or the use of rep and warranty insurance yet. So I think it's all in the eyes of the beholder at this point.
Thank you, gentlemen. Jacques from Anserata. Just wondering, Alex, you touched on this a little bit, but have you ever encountered any situations where the labor laws of the country in question had an impact in some way on a deal?
I mean, they often have impact in terms of big impact. What I went through in the UK wasn't necessarily labor law, but frankly, the same concern you'd have in a US transaction where you have, especially, ARM was kind of a national treasure, and the UK government wanted to feel comfortable that we would continue investing onshore in that national treasure, despite ARM was, their currency, they were listed in the UK, they reported in pounds, but they had something like 95% of their revenues in dollars, right? It's a global business. They have a big base in San Jose. They have customers, US, China, Europe. And so it was more about a desire to stay, to keep employees there. But yes, local regulators, whether it's in a soft way or there's actually something written down, tend to care very much about jobs, right?
Yeah. Or I would say yes and yes. I'm thinking of 2 transactions at Intuit, one in New Zealand, one in Israel. In both cases, this less mature emerging company had classified employees as contractors, taken an aggressive stance that we weren't comfortable with. And as we got into diligence, we felt that created, there was a tax liability, that kind of emerged in diligence that in order to preserve brand, we felt we had to reclassify them, pay fines. And in both cases, it did become a deal issue that adjusted what we paid for the company.
And I would add just a couple things. One, works councils, of course, European countries in particular, labor unions in places like Japan, you have to take into consideration their role in the approval process. Some countries worse than others. I would say Germany has done a fairly good job of moving that from a very difficult review and approval process to one that is generally fairly manageable. But I would also say I have done a transaction involving a German company where it was a carve-out with many different businesses in many places in the world, one of which was France. And here's a pitfall for the unwary if you ever hear one, which is the French company was a separate subsidiary and we were buying the shares of the French company. We were advised by French counsel that it would be a criminal offense to sign an agreement to purchase those shares before the French Work Council had signed off on that. So, criminal, yes.
Any additional questions? It's interesting. I deal in Latin America, and all the deals I've heard of from here exclude Latin America. Could you just tell us why?
Well, working on 2 transactions, actually 3 at present, that are Latin American-based companies. 2 of the 3 have, one is registered in the U.S. One is a company that chose for tax reasons and I think favorable body of law, they're registered in the Cayman. Those transactions, in a lot of ways, at least to us, look very similar to US-based transactions. There's fewer war stories and issues that come up. And I think the founders did that in order to present themselves as a more vanilla type company and potential investment to potential investors. The third, that's a Brazil-based company, is one that we are having to sharpen our pencils and really, retain, counsel, local counsel, and even then some advisors to help us sort through the tax law, the regulatory law, and it's taking longer and slower.
And we have made an investment in Brazil. It was a good investment. It wasn't enormous. I wasn't personally involved with it. We're not, consciously excluding Latin America. We just have been less invested there geographically relative to other places.